Bank, FD or debt fund, where is it wise to invest? Imagine a family has saved 10 lakh rupees through years of hard work. The father wants the money to remain safe, the mother wants it to be available immediately if needed, and the son asks, if a higher return than an FD is possible elsewhere, then why keep all the money in the bank? This is where the fear begins, because investing money in the wrong place doesn't just lower the return. Sometimes, the money can even get stuck. And if one chases higher returns without understanding them, that same investment can become a source of tension. The curiosity is a bank FD actually better or is a debt fund? Is an FD only for conservative people and a debt fund for smart investors? Or is the real answer hidden somewhere between the two? In India, an FD or fixed deposit is viewed not just as an investment, but as a matter of trust. Elders in the house say, put the money in the bank, you will get fixed interest, and your mind will be at peace. The biggest advantage of an FD is that you know exactly how much money you will receive at maturity. The interest rate is fixed, the tenure is fixed, and the estimate of the return is clear. This is why retirees, conservative investors, and those keeping emergency money still highly favor FDs. There are fewer surprises here, so there is less fear in the mind. But with the comfort of an FD comes a limitation. If inflation is higher than your return, the money will appear to be growing on paper, but its purchasing power will not increase at the same rate. Now let's come to debt funds. A debt mutual fund invests your money not in shares but in bonds, government securities, treasury bills, commercial papers and other debt instruments where companies or the government borrow money. AMFI also describes debt funds as funds that primarily invest in bonds or other debt securities. In simple terms, understand it this way. In an FD, you give money to the bank. In a debt fund, a fund manager invests your money in the debt instruments of various borrowers. In an FD, the bank takes money from you to lend it out and pays you a fixed interest. In a debt fund, the fund manager buys market-linked debt papers, the value of which can change based on interest rates and credit quality. This is the biggest difference. In an FD, the return is fixed. In a debt fund, the return is not fixed. Rather, it can go up or down based on market conditions. Many people consider debt funds to be as safe as FDs, but that is not entirely correct. A debt fund is not as volatile as an equity fund, but the risk in it is not zero either. It is important to understand three major risks in a debt fund. First, credit risk. Second, interest rate risk. And third, liquidity risk. According to AMFI, risks such as the issuer's inability to pay, changes in market price, and liquidity are present in debt securities. Credit risk means that the company or institution that issued the bond may not be able to pay the principal or interest on time. If a debt fund has bought papers of weak companies in pursuit of high returns, the problem can escalate. Therefore, choosing a fund just by looking at the returns is not wise. Interest rate risk is also very important. When interest rates rise in the market, the price of old bonds can fall. When rates decrease, bond prices can rise. For this reason, there can be more fluctuation in long-duration debt funds. Fluctuation might appear relatively lower in short-duration or liquid categories, but the risk is still not completely eliminated. Liquidity risk means whether the fund will be able to easily sell its debt papers when needed. Liquidity is better in high-quality papers, but money can get stuck in weak or stressed papers. Now, it is also important to understand the safety of an FD correctly. Many people believe that money kept in a bank is completely guaranteed, but DICGC insurance covers each depositor's principal and interest in a bank up to a maximum of 5 lakh rupees. This does not mean that keeping money in large banks is unsafe, but an investor must understand what the legal limit of the guarantee is. There is also a small risk in an FD, the return risk. That is, if you have locked a long-term FD at a low rate and rates rise later, your money might remain trapped at the old lower return. On the other hand, if rates fall, an old high-rate FD can become an advantage for you. Therefore, timing and tenure also matter in FDs. In debt funds, YTM or yield to maturity is an important number. It indicates what the approximate yield looks like from the current portfolio of the fund, but it is not a guaranteed return. It is also necessary to look at average maturity and duration. The longer the duration, the greater the impact of interest rate movement can be. This is the reason why selecting a debt fund by just looking at past returns can be a mistake. You should also see what quality of papers the fund is investing in. If a fund is giving slightly higher returns, ask the question, is it taking on more credit risk? Because in the debt market, extra return often comes with extra risk. Now let's talk about tax, because the real return on an investment is only understood after tax. FD interest is usually added to your income and is taxed according to your slab. In debt mutual funds, some investors previously had an advantage due to long-term taxation and indexation, but after the changes in rules, the tax benefit in many debt-oriented funds has decreased. According to AMFI's tax regime note, under Section 50AA of the Finance Act 2023, gains on specified mutual funds acquired on or after April 1, 2023, can be treated as short-term capital gains. The Income Tax Department's Section 50AA page explains the definition and rules for specified mutual funds, which also include changes related to debt and money market exposure. This simply means that today it is not correct to assume that a debt fund is better than an FD just from a tax-saving perspective. Now the comparison has become more practical, based on risk, liquidity, return and goals. Now the question arises, in which can the return be better? The rate that the bank is offering you in an FD is your base return. In May 2026, some banks were offering rates of around 8% on 3-year FDs for senior citizens, but rates vary according to the bank tenure and customer category. Returns in debt funds are not fixed. Sometimes you may get more than an FD, and sometimes you may get less. Specifically, the interest rate cycle and the quality of the fund portfolio matter a lot. If interest rates fall in the future, some debt funds may get the benefit of capital gains. But if rates rise, the fund's NAV can come under pressure. Now understand a practical example. If a person has to pay their daughter's fees after 3 months, that money should not be kept in a risky or volatile product. In such a case, options like FDs, savings accounts, sweep-in FDs, or liquid funds can be considered, but the safety of the goal must come first. If a person has an emergency fund that might be needed at any time, the money should be in a place where both liquidity and stability exist. Many banks charge a penalty for premature withdrawal from an FD. In debt funds, there can be an exit load in some categories, and the redemption amount depends on the market NAV. Therefore, liquidity is not just about being able to withdraw money. Liquidity means the money comes out quickly, comes out without a major loss, and the process is simple. Now, if an investor is slightly informed, the time horizon is clear, and they can understand market-linked fluctuations, then a debt fund can be a useful tool for them. But if an investor is afraid of seeing daily NAV movements, or if they want a guaranteed return, then an FD might be more suitable for them. A major misconception should also be broken here. An FD is not something from the old days, and a debt fund is not a compulsory choice for every smart investor. Smartness is not in the product but in the matching. What is your need? What is your risk capacity? What is your tax slab? And when do you need the money? These are the real questions. If your goal is very short-term, such as making a payment after 2 months, then certainty is more important. If the goal is a bit longer, then a carefully chosen debt fund can have a role. The importance of FDs for senior citizens also remains because they need predictable cash flow. The monthly or quarterly interest option can help them with household expenses. But even for senior citizens, putting all their money into a single bank or a single tenure can reduce flexibility. Laddering, meaning FDs with different maturity dates, can help. In debt funds too, one category is not right for everyone. Overnight funds, liquid funds, ultra-short duration funds, short duration funds, corporate bond funds, gilt funds, everyone's risk profile is different. In AMFI debt fund categorization, liquid funds are associated with securities having a maturity of up to 91 days, while the maturity profiles of ultra-short and short duration funds are different. Therefore, if someone says a debt fund is good, you should immediately ask which debt fund? Of what duration? Of what credit quality? For what goal? There is a different risk in corporate bond funds, a different risk in credit risk funds. In gilt funds, credit risk might be low but interest rate risk can be higher. This is the very place where it is necessary for an investor to study a little. One should look at the fund's fact sheet, portfolio, average maturity, modified duration, YTM and expense ratio. Even in FDs, one shouldn't close their eyes and just look at the bank's name. Cooperative banks, small finance banks, private banks and public sector banks all can have different rates, and their risk perception can also be different. Often people put money in small banks after seeing higher rates. An extra 0.50% return feels good, but safety and the insurance limit should also be understood. Investing blindly in a debt fund after seeing a higher return can be a similar mistake. If a fund is taking more exposure to low-rated papers, then along with the return, the risk can also increase. A wise investor does not look at FDs and debt funds as enemies. They look at both as tools for different jobs. An FD can provide stability to your portfolio. A debt fund can provide liquidity, diversification, and the possibility of market-linked returns. If someone does not have an emergency fund, safety should be built first. If safety is already there, then options like debt funds can be considered gradually by building understanding. The investment decision should not be based solely on where will I get more return. The right question is, where will my money remain safe according to my goal? If your money is for a daughter's education, a house down payment, or a need for next year, then there is no point in taking unnecessary risk. If money is parked for 3 to 5 years, high-quality short duration or target maturity type debt products might be interesting for some investors, but the selection should be careful. The tax slab can also change the decision. For an investor in a high tax slab, the post-tax return will be different. For one in a low tax slab, it will be different. Interest in an FD can be taxable every year, regardless of whether you have withdrawn the money or not. In debt funds, taxation usually occurs upon redemption, but rules can depend on the category and purchase date. Therefore, before making a tax comparison, it is necessary to check current rules and talk to your CA or advisor. Taking decisions by reading old internet articles can be risky. Now, if you want a simple answer, an FD is better for those who want certainty, a feeling of safety, and a fixed return. A debt fund can be better for those who understand market-linked products, can read risks, and can tolerate some fluctuation. But moving all your money from an FD to a debt fund is not wise, and keeping all your money just in an FD while ignoring inflation and opportunity is also not right for everyone. The best approach can often be a mix: emergency and near-term needs in FDs or highly liquid safe options, and a slightly longer debt allocation in carefully selected debt funds. Also remember that in financial planning, the product comes later, the purpose comes first. When the purpose becomes clear, choosing the product becomes easy. An investor should ask themselves 3 questions. When do I need the money? How much panic will I feel seeing a loss? And how much real return will be left after tax? If the answer to these 3 questions is not clear, then any product, even if it looks good, can prove to be wrong. An FD can give you sleep, peace of mind. A debt fund can give you flexibility and the possibility of better returns. But neither of them is a magic solution without understanding them. In reality, the biggest mistake in the investment world is not that you chose an FD or a debt fund. The biggest mistake is that you followed someone else's advice without understanding your own needs. So the next time someone says that FDs are useless or debt funds are risky, do not decide immediately. First, look at your goal, look at your time horizon, look at the risk, and look at the tax. Because the right investment is one that stands by you even under the pressures of your life, one that does not cause fear at night, and can make money available at the time of need. The real battle between FDs and debt funds is not about returns but about understanding. For someone who understands the product, both are useful. For someone who does not understand, even a thing that looks safe can become a source of confusion. So the question is not whether an FD is better or a debt fund. The real question is, does your money need safety right now, liquidity, or a chance to earn slightly better returns? And when this answer becomes clear, the path for investment also becomes clear. Invest your money where your goal, risk, and needs match together, because a smart investor is one who understands the purpose of their money before the return.
If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible. But in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.